to our first conversation. So much has happened in the Nigerian economy in the past week, and according to the latest data from the Central Bank of Nigeria, money supply increased about 64.3 trillion in the month of June 2023, the highest ever recorded in Nigeria. This compares to about 55.5 trillion recorded in the month of May, making it about 8.8 trillion naira higher. To discuss the expected impact and how we got here, joining me is Mr. Johnson Chukwu, CEO, MD/CEO, Cowrie Asset Management. Great to have you on the show. Good morning. Good morning. I think you might have to unmute there.
My apologies.
All right, fantastic. Yeah, I can hear you. I can hear you better now. Good morning, Mr. Chukwu. Thank you so much for joining us. So we see quite a big jump in the money supply in the Nigerian economy. That's a big 8 trillion naira from May. What do you think drove this jump? Are we printing too much naira? Okay, fantastic. I can hear you now. Yes, I can hear you.
Okay, can you come up with the question again?
Yeah, so I said big jump, for the money supply we saw in June. That's 8 trillion more from May. What do you think, drove this jump? I'm wondering, are we printing too much naira?
No, not really. The jump is what I may call an internal adjustment. And basic thing that has happened is that the central bank has begun to adjust downwards the cash reserve ratio of banks, and then freeing up liquidity for the banks. And that increased, partly contributed to the increase in money supply we are seeing now. In addition to that, remember that the federal government has done two things. They've deregulated the downstream oil and gas sector, and they have also harmonized the exchange rate. The harmonization of the exchange rate means that conversion of all foreign exchange earnings from crude will be converted at higher naira value. So that also has direct impact in terms of system liquidity. So two major factors that are accounted for this are, one, the adjustment in cash reserve ratio. And even the central bank has said that for merchant banks, their cash reserve ratio will be adjusted from 32.5% to 10%. For the commercial banks, the cash basis for computing the cash reserve became very opaque. And what has happened is that the central bank has now adjusted and freed up a lot of those amounts that were sterilized, which came back into the same liquidity. So those are the two factors that drove it, not because central bank went about printing more money. Of course, I'm not sure we have the figures for any ways and means funding that may have happened in the month of June, but I doubt if that will be very material to us to contribute to the kind of liquidity improvement that we're talking of.
And for a while now, since global inflation was spiking, we've seen, experts accuse, central bankers of printing too much money for stimulus, when we had COVID-19, and that's why we're seeing so much inflation, right now. But looking at this jump from May, what is the expected impact of this? And must this kind of money supply, must it stoke inflation?
Well, ideally, an increase in money supply will stoke inflation if that money gets into the hands of consumers. But as it stands today, the excess money supply is just within the banking system. The impact of having that liquidity with the banking system in the banks will reduce their interest rate on deposit because they have surplus funds. They're not really going to go out there begging people to bring in money. So in terms of buying money from the public, the banks are the market makers. The bank, what they call the market power now resides with the banks. They are in a position to negotiate downwards interest rate, which is what will happen because with the level of liquidity they have, they are not likely going to go bullish with risk asset creation. So they have a kind of liquidity suffix that they will not just give out. So they won't have any need to pay you premium to have your deposits. So the banks are going to reprice downwards their deposit rates. That is what I think will happen. The impact is going to happen. But then in terms of lending, it should also give borrowers the opportunity to negotiate downwards their loan rates, particularly triple-rated borrowers, because the people with credit will normally pay huge risk premium to borrow. But the companies and individuals with strong credit standing will be able to negotiate lower loan rates from the banks. But what you are going to see is that lower deposit rates, possibly lower borrowing rate for those blue chip companies, and the HNI is high net worth individuals. And then we'll also see, because of lower deposit rates, we're already seeing a lot of investment going into the equity market. So you are going to see more of that, because if people can't get good yield or good return on their fixed income instruments, the option they have is to go into equity instruments. I think that's what we should expect from the economy in the next couple of weeks.
I would have jumped like what we see from May into June. Is it necessary to mop up at this time, excess liquidity? Is that the right move right now? And are there other ways to mop up without, raising rates?
Well, I don't think there's any need for the mop up. Like I said, the liquidity we have today is not in the hands of consumers. It didn't come about as a lot of credit creation where the banks are granting overdrafts, and when a bank grants overdraft, they actually create money. It's not coming from that. We're not seeing expansion in credits. So it's not going to impact on consumer demand. And the reason why central banks mop up liquidity is to moderate consumer demand. Today, the consumers are actually stifled. We've seen jokes around that consumers said they can't breathe, allow the consumers to breathe, because they don't have disposable income. There's no improvement in average consumer disposable income. So what we rather see is that in the vaults of the banks, you have higher balances, higher credit balances with the central bank, higher balances in all their investments in short-term instruments, money market instruments. That's what you're going to see. But so there's no compelling need for the central bank to do a mop-up, because that mop-up will simply means we have seen so much credit going into the hands of the consumers, and then we need to tighten the interest rate so that people will stop borrowing more and stop consuming. We don't have that situation. The reverse is rather the case. Consumers are even looking for headroom to even buy basic necessities of life. I don't think there's a compelling need for a mop-up.
And definitely with consumers squeezed at this time, what are you seeing for the second half of 2023? How do you think this is going to impact businesses going into the second half? Because right now, consumers are trying to breathe, as you said.
Yes, I think what we should expect is that the conditions of consumers will remain largely about the same for the next couple of months. There's not going to be any structural change in the economy in the next couple of months. In terms of fresh income, new income, maybe when the government increase the salaries of workers, and then you're going to see a new source of cash flow coming into the pockets of consumers, and that will lead to an improvement in demand. But as it stands today, we should see a slowdown in demand, we should see a slowdown in production, and then we should see a slowdown in employment. So you're going to see a high level of unemployment, a lower level of consumption, and ultimately a reduction in GDP growth rate.
Yeah, and we're going to have the first MPC meeting for the Tinubu administration. What do you think the CBN MPC will do at the next meeting with inflation now at 22.79%, Naira volatility, and, since the money supply growth is not a problem, what are they going to do at the next meeting with all of this? Do you expect a pause, a hike, or maybe a cut?
I think we're going to see a pause. They will likely going to keep rates at current levels. A couple of factors have to come into consideration in what they will do, based on my thoughts. One of which is that the inflationary pressure we're witnessing today is not driven by credit expansion or consumption. So you're not going to manage it by tightening rates so as to make cost of borrowing higher. And again, we don't even have consumer credits in the country, unlike where you have in other countries. That the consumer credit is the most effective transmission channel for monetary policies. We don't have that. The other factors you have to look at that the central bank seem to have been decapitated. So you're going to see a monetary policy committee that might not be as independent as they used to be. And they're likely going to toe the language or the lines of the executive. We know what the president said. They want to encourage private sector investments, and they want to review monetary policies. And if you say you want to review the monetary policies have been very contractionary in the past couple of months. So a review of it simply means you are saying the opposite of what they were doing, which is doing an expansionary monetary policy. But I don't think the current environment, given the pressure you have on foreign exchange, will allow for an expansionary monetary policy. The most likely thing they will do is to hold rates at current levels.
And how do you see this impacting the capital markets in Nigeria going into the second half of 2023?
Yes, like I said earlier, what basically investors do is that if fixed income yields are high, they will underweight their portfolios in equities and overweight them in fixed income. Like what we're witnessing today, I said, with a lot of liquidity we're going to have, or that we're likely going to continue to have in the next couple of months, interest rates are going to go down further below where they are today. And the investors will look at, if instead of getting a yield of maybe 6-7%, on my fixed income instrument. I know most deposit-taking institutions have dropped their rates drastically, and that will even worsen in the next couple of months because the level of FAC allocation we should expect in the coming months are going to be almost twice what it used to be, or even more than that. So that will go still back into the banking system. So rates are going to come down, and discerning investors will obviously look for alternative asset classes to invest, which is equity in the Nigeria situation. So I should expect a lot more votes, Naira votes will go into the equity market in an environment where interest rates on fixed income instruments are going to remain low.
All right, Mr. Chukwu, investors are trying to, beat inflation at this time, trying to beat currency devaluation. A lot, the average investor has to deal with, right now. What do you think is the best strategy for the average investor, at this time to be able to make good returns, in the second half?
Well, you already pointed in that direction. The key thing is that if you have any foreign currency income, the appropriate thing is to invest in foreign currency assets. If you have access to foreign currency positions, you can invest in mutual funds, dollar-denominated mutual fund, dollar notes, to insure yourself against further Naira devaluation. But in the absence of having foreign currency and having access to foreign currencies, you are left with local Naira assets only. And in that wise, the equity market is a way you can actually go to see if you can possibly outperform the inflationary rates and or depreciation. There are some stocks that have gained more than 50% in the past couple of weeks, and but you must focus on stocks with strong fundamentals. But it depends on the level of resources you have. It depends on the kind of risk you're ready to take. It depends on your holding period. So all these factors will have to come into play in deciding what you want to do. We always say, look, seeking for advice, investment advice is like going to a doctor and saying, look, I need a medical diagnosis. If you go to a doctor with any ailment, the first thing they will do, they want to carry out a test. We do such head tests when we want to advise customers. We look at your age, we look at your income, we look at your cash flow, we look at your risk appetite, we look at your holding time threshold, and then we'll advise you on what asset class you are going to go into that will make reasonable return at minimal risk.
Definitely not easy holding through so much volatility right now in the investment space. But thank you so much, Mr. Johnson Chukwu, MDC Okari Asset Management. It was great having your perspective today. Thank you.